Good morning, everyone. Scott Arehart here with Insurance Agency Marketing Services. Thank you all for taking the time to join us today. We really appreciate you giving us some of your busy time. Today, I think you're going to find what we're going to present incredibly valuable. This will be our 5th Department of Labor webinar. We've had thousands and thousands of advisors just like yourselves attend in the past, and we're really excited to be able to bring you this information. Why are we doing our fifth Department of Labor webinar right now? Well, we're doing it because we've got some new guidance and FAQs from the Department of Labor that are going to help us navigate and help you better understand what needs to be done now. With that being said, to go through that information, we've got the IAMS Executive Vice President, our General Counsel, Mr. Chris Conroy, with us. Chris, can you hear us?
Yeah. Hey, good morning.
Morning, Chris. Chris has an extensive legal background and an extensive background in the insurance industry. He's been at the tip of the spear of many carriers, past president of NAFA, actively involved in a lot of different industry groups. So this is the guy you want to hear from on this topic. And we will, I guess, Chris, before I get into housekeeping items and intro slides, anything you want to say before we start rolling?
Yeah, I just, we've talked to literally thousands of advisors about this topic. It's caught everybody by surprise. We'll kind of go through and try to digest this, put this into small workable pieces so that you have an action plan and know what you need to do to comply.
Absolutely. We've, I don't want to toot our own horn too much, but with Chris's guidance, we've been on the cutting edge of the Department of Labor ruling. We were one of the very first firms to get out there with guidance, and we probably have a better understanding than any of our competitors. And I think you guys are going to see that, guys and gals are going to see that here in just a few minutes. That being said, I'm going to hit just a couple housekeeping items, some introductory slides, and then we'll get into Chris's presentation. First thing that I want to hit on the housekeeping items is probably the most important thing you'll hear me say today, and that's in the top right-hand corner of your screen. That's our phone number, 800-255-5055. If there's anything that we can do to help you navigate the Department of Labor ruling, assist you in your life or annuity efforts, please don't hesitate to use that phone number. Our sales directors are here and ready and very willing to chat with you. Second housekeeping item are going to be polling questions. Throughout the presentation today, we're going to launch 3-4 polling questions. They're simply just yes or no answers. It's going to help us understand what information is going to be useful for you and your business, and then help us get that collateral directed to you in a very timely manner. And then the final housekeeping item are going to be questions. We're going to cover a lot of information in a relatively condensed period of time here. So with that being said, if you have questions, type them in. We may not get to all the questions while we're live and in session, but our sales directors will follow up with you and will definitely get those answered for you. So that being said, let's get into some introductory slides here. And we want to start with our new producer builders. There's a lot of people on this line right now, and I'm sure some of you, this is your first introduction to IAMS. If you are new to us, or if this is your first introduction to us, you certainly are eligible for this program, the new producer builder. This is all based on your production within your first 180 days of being licensed with IAMS. And as you can see, there are several great levels, and inside those levels, great options for you to cash in with business building tools, personal perks, even cash rewards available to you. If you'd like to know more about the new producer builder or want to have a conversation about what we could do to help you jump up a level, just give your sales director a call. Certainly, they'd love to chat with you about that. Moving on to the business builders. These are 2 programs that are incredibly popular with IAMS affiliated producers, and we're going to start with the referred producer program. Our business on the wholesale side of the industry is very similar to yours in the field, in that one of the best leads we can ever obtain is a referral from one of our valued clients or you, our valued producers. So we want to make it worth your while to refer individuals over to us. To prove that, we're going to give you a $50 check when you refer someone to us and they pick up any licensing agreement through IAMS. Now, where the real money comes in is as your referral writes business, you're going to receive an override on that. You can see those percentages down there. Our ownership team, Steve, Charles, Curtis, they sign these checks at least quarterly. These checks total into the thousands and thousands of dollars at a time. So it can be very lucrative for you. If you know of someone that could benefit from doing business with IAMS using our services, just let your sales director know who they are. Feel free to email me their information, scott@iamsinc.com, or when we call to follow up, let us know who they are. Certainly, we'll do the best we can to get them introduced to IAMS, get them to pick up a license, and get you on your way to earning some referred producer dollars. Below that is our most popular program, and that's marketing reimbursement. Rough numbers on that: every $100,000 in FIA premium you place through IAMS, we put $100 into your marketing reimbursement account. Now, what makes this program so popular, and in my opinion, makes it more lucrative than any of our competitors, is we really do consider this to be your money. What I mean by that is we are not going to tell you when you have to cash it out. We're not going to cap you on how much you can put into that account. And also, we're going to put very, very few restrictions on the vendors that you utilize. What I mean by that is if you've had success with a firm in the past to develop marketing for you, we want to encourage you to continue that relationship and flourish in that relationship. All we're going to ask is you send us the receipt or the invoice from that marketing expense. We're going to cut you a check, hopefully that same day, and help you offset that expense. If you'd like more information on either the referred producer program or the marketing reimbursement program, just give one of our sales directors a call at 800-255-5055. All right, back office support. This is the core of who we are here at IAMS and how Charles Hiring founded us some 36 years ago now. We will help you work smarter, not harder. All of our business endeavors every day are designed to help the independent advisor life get easier. We're going to do that with great business building tools and resources. You can see a lot of these programs at IAMSinc.com. You can chat with your sales director about how to access many of these programs. A lot of great stuff is available to you. Case design assistance and life and annuity quotes. We're going to make a 24-hour guarantee to our clients that we're going to have you the case design assistance or the illustrations you need within 24 hours. And I'm going to tell you, I put that 24-hour stamp on there. I've got a little graphic somewhere, 24-hour guarantee. But in all reality, it's going to be less than that. We just give ourselves a little bit of buffer. Normally, you're going to get whatever it is you need, forms, supplies, illustrations, from our office within just a couple hours of your request. Forms at your fingertips. Obviously, all you have to do is let us know what you need. We're going to get that for you. Of course, you can access many forms online as well at IAMSinc.com. Submission to commission support. We have dedicated new business staffs, both life and annuity, here in our office, and all these ladies and gentlemen do is make your business move through faster. That is their only goal, is to get you commissioned as quickly as possible and get that policy in your client's hands as quickly as possible. We will scrub apps for you. We will submit those apps on your behalf, and we will track any requirements or anything and give you updates constantly on your business. If you have questions about how that works, let your sales director know. And the one thing I do want to point out about the submission to commission support is there's no fee for that. That's just our standard business practice. Top sales expertise and coaching. You're going to see some great sales expertise or just industry expertise here today. Know that our staff here has a ton of experience. We've got national sales coaches that are top producers available to you as well that will help you grow your business. And then paperless contracting. Chris will laugh when I say this, but because I'm going to date myself. But we all, if you're as old as I am or been in the business as long as I have, you remember the hand cramps of filling out individual licensing agreements. Those are gone. Fill out paperwork once, and we can get you appointed with probably 95% of our carriers. If you'd like to know more about the Assurance Bay platform, or we refer to it as paperless contracting, just let your sales director know. They can walk you through it. Next thing, and we're going to continue the theme of avoiding hand cramps with this, Firelight, e-apps. This is the future of our business. We do have the Firelight portal that you can access via a single sign-on at IAMSinc.com. With that being said, If you haven't ever done an e-app, I will tell you it will change the way you do business. You cannot submit e-apps that are not in good order. It'll tell you what you missed. It'll tell you what you need to put in, or not what you need to put in, but where it is you missed a box or something of that nature. Super, super easy. And it's also an incredibly COVID compliant way to do business, because you don't even have to meet with the client or be in the same room with the client when you're doing this. You can do e-signatures. Very, very easy to utilize. Again, all of our sales directors are very familiar with Firelight, so if you have questions on that, just let us know. Creative marketing solutions. We do have an in-house creative team here at IAMS, and Chris, I think you've got the polling questions. Would now be a good time to ask our ladies and gals, or ladies and gentlemen, if they'd like a free marketing analysis?
Yeah, I mean, this is a core part of what we do, obviously, Scott, is to help all of our producers grow their business. And so we will do a thorough marketing analysis so that we can help you determine what's the best strategy to reach your goals. I'm going to launch that poll question.
Absolutely. Thank you for putting that up. If you click yes on this polling question, you're going to get connected with one of our sales directors. We're going to schedule a time to do that in-depth marketing analysis for you. And the reason that we do the marketing analysis is to get a better understanding of your business and how we can help you market yourself and grow your practice better. And a lot of what's going to come back are things that our in-house creative team can do to help you, whether it's revamping a website, upping your social media presence, helping you with your SEO, or drip email marketing. All that is going to be available to you through IAMS, and you can access that through IAMS, and we can create and map out a strategy and a plan to help you implement these things piece by piece and really, really grow your practice. So if that's of interest to you, click yes. Set up that marketing analysis call with the sales director. We'd love to run that for you. Chris, you think we're ready to move on? Anything you want to add on about creative?
I think we're good. We'll wrap up our commercial here a bit and move on pretty soon to my presentation. Yep.
Oh, absolutely. Absolutely. IAMSinc.com. I've mentioned it several times. I don't need to spend any time on this slide here, but just know it's available to you. If you haven't created an account out there, please go do so after the presentation. The fun stuff, the Top Producer Summit. We are in the middle of qualifying for this. 4.5 million points to qualify. The trip qualification period runs through the end of next June, or June of 2022. And as you can see, we're going on a Mediterranean cruise. So really excited about that. Let us know if you'd like to know how many points you currently have, or a conversation about how to get that up, or how to get you over that 4.5 million threshold. That being said, Mr. Conroy, the slides are, we're now done with the commercial. We are on to the meat and potatoes, and go get them, boss.
All right. Well, happy to, hey, thanks again, everybody, for joining today. And we're going to try to be brief and try to run through and put down in nuts and bolts what this new DOL fiduciary rule is. And I think, ultimately our goal is to be an advocate for you as an independent advisor, keep you up to date on what you need to do. And as you'll see, we have a compliance package really to help you to continue to operate and sell these great products that we're pleased to help partner with you on getting to the consumer. So this is frankly one of the hot topics we've seen this entire year. Literally thousands of advisors have been on the first 4 webinar programs, and so we continue to offer more of these programs. We have additional new guidance that came from the Department of Labor on April 13th. That was our 4th installment. Our first one was actually on the day that the rule took effect, believe it or not. It was back on February 16th, which nobody really expected. There's a lot of misinformation out there, I will tell you, a lot of sound bites and incompleteness. There's a little bit of carrier information. We'll share that at the end. Just know that our goal here is to share with you real-time information and real solutions. So this is a complicated rule. We're going to try our best to keep it high level and keep it practical. There is a lot of confusion out there. We've heard things from advisors who are angry, saying, no, there's no rule, it's not in effect. Some other groups saying, well, you don't have to do anything, no change at all until December. And further, we're waiting for the guidance. We really don't have to do anything until then. I guess I'd tell you this: if you got a group that's telling you don't have to do anything, you probably ought to ask to see if they can pay your E&O insurance, because that's not the state of affairs today. So moving on to the next slide there, Scott. Just again, we are an advocate for you. That's a picture of me lobbying out there in DC a year or two ago. We're your advocate. We're a partner, a premier partner with NAFA, National Association for Fixed Annuities. I'm the past chairman of the government affairs and past chairman of the board there. We do a lot of hill walks and lobbying at the state and federal level, and just know we're sticking up for you. So we win when you win. We know that's important, that you got somebody who's sticking up for you. In our case, we're a big advocate for fixed annuities and also life insurance. So we're involved in the key trades there. Moving to the next slide. So a lot of questions about, is this rule really going to take effect? So on the left there is actually an excerpt, that's page 1, when this was put in the Federal Register. So it's a regulatory rule put forward by the U.S. Department of Labor, and that was put into effect put into the Federal Register back in December. And I think everybody handicapped that, well, a Biden administration's coming in, they're probably going to bounce it. It's just kind of the nature, especially change of administration, that the new department could just bounce it, and they could do that by regulatory rule because it was put into the Federal Register so late. It's important to note, though, this rule actually is something that started back in 2010, believe it or not. So originally back then there was a rule, think of it as like Proposal 1.0, and that rule was killed by congressional efforts. 2015 rolls around, and there was actually Proposal 2.0 under the Obama administration that was finalized and put in the Federal Register in 2016. Then you had some lawsuits, including some efforts that IAMS was involved with in our connection with NAFA and others. And ultimately, the Trump administration wins, or the election, surprisingly, and they indicated that they would delay pieces of that rule, the kind of contentious contract requirement. And then 2018 rolls around, and the Fifth Circuit Court of Appeals nullifies or vacates the rule, and there was a new temporary enforcement policy. Now, version 3.0 proposal came out last summer under the Trump administration, and that was finalized, let's see there, in December. So now the final rule did take effect, and as you see on the next slide there, the Department of Labor under the Biden administration confirmed that they would let this take effect, much to the surprise of many in the industry, and it will take effect. And so then you kind of say, well, go to the next slide. Well, now what? And I think there's a lot of people, these are articles, Think Advisor, Bloomberg, Pensions, saying, well, this is what it means, we're not sure. And we got Marty Walsh coming in as proposed Secretary of Labor. It looks like it's effective, but what does that mean in practice? There's a lot of confusion. That's kind of going on there. And go to the next page. And you see that there was this anticipated guidance, and it came in the form of frequently asked questions that came from the Department of Labor's Employee Benefits Security Administration. So that's the organization, that's the segment of the DOL that would issue this. And so they provided a little more guidance, and that you see the article there from Investment News. That was just 2 weeks ago. So they affirmed it for sure. Yeah, this is in effect, and you need to be doing something. That rule took effect a couple months ago, and indeed answered a couple of the questions that were out there for the industry to consume. So move on to the next slide. I guess first, there's a lot of confusion out there about, well, how does this rule work with some other regulations that are out there? And do you have to jump through one or jump through all three of them? And so think of it as there's the U.S. Department of Labor, and you have this rule that originally Obama administration had created, and that rule was vacated or killed in court back in 2018. And then the Trump rule comes in, takes effect, and that is in effect right now. It's been in effect for a couple months. That applies really to all qualified money. So 401k rollovers, IRA to IRA transfers, anything qualified it applies to. And who does it affect? It affects everybody. It affects whether you're, investment advisor, you're a securities rep, or you're insurance only. So everybody's affected if you're working with qualified money. And indeed, that's a lot of, the annuity practice, Scott. 60% of our sales probably are qualified.
Oh, yes, sir. Yep.
So, obviously a big impact. The second prong is if you're an investment advisor or with a broker dealer that's registered by the SEC, you have Reg BI, regulation best interest. And so they use that term best interest. You'll see that in a couple different places here. But that took effect last summer. And if you're with a broker dealer or RIA firm, that's registered at the SEC level, you would be very familiar with your chief compliance officer sending out bulletins and changing rules, et cetera. The other prong is the NEIC, the National Association of Insurance Commissioners. So they sought to adopt a rule that was in line with the SEC. So they wanted to have a harmonization of standards of care here, kind of up the standard from the then suitability standard. And in fact, that was passed by the NEIC, and it's got to get passed through the various states, as we'll show you here in a second. That is in the process of getting passed. So the answer is, think of it as if you're a securities rep that's regulated, your indexed annuities, for example, and it's a qualified sale. If you're in certain states, you have to jump through all three hurdles here: Department of Labor, SEC, and the NEIC. So it's kind of confusing. And I think also there was some questions, Scott, you might have about 8424 too.
Yep, we did, and I guess specifically not on 8424, although we can dive into that. Somebody did just chime in and asked, how is this rule or what we're under now different than the Obama era administration rule?
So good question. It is the rule itself, if you read it kind of in sum, it's a couple hundred pages long, actually looks and smells a lot like the Obama era rule. It doesn't have that contract requirement that was really contentious, and one of the big reasons the court threw it out. However, it is different. So keep in mind, it is a different rule. Some have asked, well, wait a second, there's this 8424 form that, that's being passed around as a solution for insurance. We'll talk about that in a second. Keep in mind that if you just Google 8424 form, you're probably going to find what was in effect under the Obama administration. And that rule was changed by the Obama administration, then ultimately killed by court decree. So I would tell you not to go take a look at those. Be careful, because indeed the Obama administration did try to change 8424. So moving on to the next slide. This is as I mentioned, the NEIC, National Association of Insurance Commissioners, as of 3 weeks ago, the update here. So this new rule is taking effect. You may be in one of these states like Arizona where it's already taken effect. Iowa's done it. A couple others are working on it furiously. Nebraska just passed it here with some lobbying efforts by us. We're in favor generally of this new model, and mainly for the reason of consistency. We think it's a balanced rule. It kind of ups standard of care, some additional requirements. But generally the industry favors a consistent model, so we're not having to jump through 50 different states and patchwork kind of compliance. I'm going to ask or launch a polling question. We have this chart updated. I think actually we have one from as of April 14th. If you're interested to know if you're in a state that has to comply or it's working on it, why don't you go ahead and answer yes, because we can get you that. Our partnership with NAFA gives us an update every couple weeks. A lot of people might be seeing stuff from various carriers. Carriers are handling this different ways, but we certainly get you the most recent information. This gets updated pretty frequently, but you'd have to know that you need to jump through each of those state requirements. Like I mentioned, Iowa and Arizona were the first two. I'm going to close that poll here. Right. Okay. The other resource that we have here is the compliance guide. So, we were, I think, overwhelmed by the first webinar. I mean, I think we had 800, 900 people on that. And so we decided we need to create a toolkit, something really practical. It kind of supplements what we were doing on this webinar. And we could get you that. I'll do a polling question right now. Just if you would like that summarizes kind of key points, what you need to know with regard to this new rule and how you might comply. So I'll launch that one. Again, we'll move through this pretty quickly, but we do have a lot of resources available to any of our advisors that we're doing business with. Happy to get you that information. That's another good resource. It supplements everything that we're covering today. So I'll go ahead, keep it open for a few seconds here. All right. Wow, 100% wanted that thing. I guess that we got something there pretty valuable, Scott. Okay. Well,
it is valuable, buddy.
It is. Okay. Well, so now I'm going to try my best to boil this down in nuts and bolts. I talked to a lot of lawyers in DCs, a lot of lawyers with the various carriers. I myself was involved in the brief writing and all the work that we did back 5 years ago when we sued the federal government and won. So we're going to do our best to try to keep it as high level as possible. So first of all, there's a couple components to this rule. The first one is really, really important, is what's called the preamble or the final interpretation. So you kind of say, well, what is that? Well, in the Federal Register's rule, what preceded it was literally a 100-page defense or interpretation of what they were doing in the rule. So one big difference is in that 100-page defense, that preamble, which is binding, it really changed kind of the scope of who is covered by this rule. You know, when you are functioning, for example, on a primary basis of giving advice to people, they've really broadened it and kind of defended why that is. Marketplace has changed, etc. They also looked at, the regular nature of your relationship with your customer. And under the old rule, old interpretation, that was pretty narrow, and they really broadened that. So really to cover everybody that's within the scope of that regular recurring relationship. The other thing is they went to lengths to talk about, well, you can't just disclaim it. You can't just put a written disclaimer out there and say, well, I'm not functioning as a fiduciary for you. And they said that just doesn't work. It depends more upon what actually happens in practice. And then some noise in there about enforcement, the ability to use enforcement mechanisms under Title I of ERISA. So that's the final interpretation. I would say the key is that they've really broadened and clarified that their intent is that this rule applies to everyone and that you couldn't really find a good workable exception to it. Number two is the reinterpreted 5-part test. So this is kind of the core guts of this. A 5-part test references back in 1975. So I don't know, Scott, you and I, maybe we're not quite in the business, but I think I was born by then. But we were back then. What we had is the Department of Labor clarified that in order to be an ERISA fiduciary and be covered by the ERISA standards of care here, you really had to meet all 5 components of a 5-part test. And those include 1, advice. You had to provide advice on securities or property. 2, on a regular basis. 3, under a mutual agreement. 4, that advice you give to the client needs to be the primary basis for their decision. And then 5th is the advice needs to be individualized to their specific needs. So in practice, that 5-part test provided a lot of means by which people just weren't covered by it, mainly because they didn't have a written mutual agreement with the client. They weren't functioning as, for example, an investment advisor with respect to their insurance and annuity sales. Well, that was broadened under the Obama administration, and then again broadened under the Trump administration's rule. So that 5-part test is much, much broader. Keep in mind that the Fifth Circuit Court of Appeals that killed the Obama administration, went to lengths to talk about, well, wait a second, I think they've kind of overreached here, and I'm not sure they can do with it. The Trump administration has sought to defend that. That's why they put 100 pages into their defense. And they try to really thread the needle here and make sure that everyone is covered. There's no real exceptions to it. So that 5-part test is kept, but they've reinterpreted what those words mean. So, and which they can do with the kind of basis they put forth in the defense there. The third thing is the Trump administration 2020-02. So there's this defense, they broaden the scope of everything, and then you got kind of the guts of what you need to do to comply. We'll cover that in a second here. But, keep in mind the Department of Labor, you say, well, what do they have to do with all this stuff? Well, they have authority over ERISA plans, 401k, 403bs, and also rollovers coming out of there. They have the interpretation authority for the IRS. So the IRS has oversight over IRA to IRA transfers, notably. And keep in mind that, so this rule does apply. There's no like exception to say, well, it's IRA, I don't have to worry about it. That's not true. And that was clarified in their 200-page release. So there is one compliance pathway through this new Trump administration rule, or what's called a prohibited transaction exemption, which, federal government's notorious for, complex words and acronyms and so forth. The key there is, in principle, the government says, if you're working with qualified money and you're going to get paid any commission at all, that's prohibited or illegal, unless you have an exemption, a prohibited transaction exemption. So that's what that PTE stands for. For the insurance world, importantly, you have 2 pathways. You could jump through the 2020 rule, or you could jump through this 8424 rule that we'll talk about, and we certainly recommend at this time. So that's been available since 1984. It's really in the context of IRA rollover recommendations, kind of one time. And the Department of Labor clarified in their couple 100-page release that indeed you can use that 8424. That's still a viable exemption or a compliance pathway. So there's the new rule. We'll go into a little bit of detail here, kind of when you might use it. There's also that insurance and annuity exemption, which is 8424, and we'll talk about what that means. Scott, you have a question?
Chris,
here?
I did have a question pop in, and it's really asking, why do you think the Biden administration didn't delay the Trump rule and allowed it to go into effect? What was the thinking behind that from the administration?
You know, that's a good question. A little bit of speculation, talking to some lawyers, friends at DC. We think, this rule had a lot more teeth than the industry ever thought it would have. And so, some of it is maybe, hey, we got something that's better than nothing. And the Department of Labor, as it said in their release a couple weeks ago, is going to be taking another look at this. So there probably will be another bite at the apple. I know the Biden administration's got other big priorities in the labor front, like getting $15 an hour minimum wages and COVID relief, worker protections, et cetera. So I think it was just, let's get something on the books and let it go, and we'll get back to it in time. So move on to that next slide. Again, we'll try to cover what this is really in short. And again, you can jump through either this new rule or use the quote old 8424, that old exemption. We'll tell you how to do that. Again, much like the Obama rule that was controversial, a key part of the Trump administration's 2020 rule is you need to have a financial institution, an overseen entity, and there really are only four. Those include an RIA, a broker-dealer, a bank, or an insurance company. So if they're going to use that pathway to comply, you need to have an overseen financial institution that will make sure that you're adhering to all those standards that are required. The old 8424 is really a reference to the 1984 regulation that allowed for, get paid commissions on insurance or annuities. This was attempted to get changed under the Obama administration. Some might remember been around that FIAs were going to get treated differently than declared rate annuities. That ultimately was killed in court, so that rule does not apply. It really is not something that you should be looking at because that rule had changed. And then, there's a third theoretical compliance pathway, but frankly, after the new guidance that we got, we don't see it as a viable solution. So some might be saying, well, if you're just, we're going to do a one-time sale, then that's not a recurring relationship, and maybe you're exempted. You're not covered by that 5-part test. And the department, and it's a couple 100 pages plus in the clarifying release a couple weeks ago, said that's not really a viable solution. I mean, maybe in theory, Scott, if I, came in there, I said, hey, I'm going to sell you this, declared rate annuity, and I'm never going to talk to you again. I'm never going to call you. I'm never going to email you. I'm never going to have anything that might be construed as an ongoing kind of relationship or basis. In theory, that I think that could work, but I haven't heard any lawyers say that would work. So, and I think any good advisor is obviously going to continue to talk to their clients. Then we have the last piece, which is Department of Labor's Field Assistance Bulletin 2018-02. So you say, what does that have to do with anything? Well, on the heels of that court win by the industry in 2018, the Department of Labor said, well, for the time being, we're going to let you, as long as you comply with the impartial conduct standards, we're just going to let you comply, which means you continue to get paid compensation. Because without an exemption, without a PTE, it'd be illegal to get paid any money. So the department said, well, for the time being, as long as you comply with the impartial conduct standards and you're doing something in 2021 until this rule, the 2020 version of Trump rule takes effect, as long as you're doing something, we'll talk a little bit about what that is, then, kind of show good faith compliance towards the rule, then maybe you're okay. Although that doesn't necessarily protect you from private causes of action. So it's kind of like Brad Campbell with Faegre Law Firm. I gotta give him some credit here. He made the comment. It's kind of like the Department of Labor is saying, well, we're going to pretend the Obama rule, was in place, but we'll just pretend that you didn't violate it. And so it's just kind of a little interesting twist there. But the reality is that everyone's got to work on a good faith compliance towards the impartial conduct standards at this time if you're looking to comply with the 2020 rule. And so those key components of impartial conduct standards include, one, you got to be managing or eliminating your conflicts of interest, which would be, for example, compensation, getting paid anything. Second is adhering to a best interest standard of care, which is different, a higher standard than just mere suitability. Third, that you can't be making any material misleading statements, which includes omissions. So by not saying certain things, not disclosing limitations or other charges, et cetera, about the recommended product, you're really violating that as well. And then last is to have reasonable comp. So reasonable comp, which we'll talk about, is based upon kind of market standards and the range of services that you're provided. So a key thing with the is to show that with compliance is that in good faith that you're actually using policies and procedures to meet the requirements of the Department of Labor's 2020 rule. So keep in mind, this is all qualified money is covered. The impartial conduct standard, let me just go a little bit into that. It's the highest standard of care is what the Department of Labor talks about. It's kind of rooted in the concept of being a trustee for a trust, or like a CPA for a client. And a classic conflict that needs to be mitigated or managed is compensation and fees, and kind of doing best execution for the client. So the legal piece of that is that there's this what's called a prudent person standard. So kind of a light capacity. You're always putting the customer's needs ahead of your own and looking out for them. So there's a prudence standard. There's also a loyalty standard. And so being loyal to that client to all ends and never putting your own interest ahead of them, for example, compensation. As far as compensation in that regard, there is a little bit of guidance that came out, and I think the clarification there is that when you're making a recommendation, you got to look at what's the range of all the services you're going to be providing. Is this going to be a one-time thing? You're not going to really provide much, or in light of the totality of the recommendation, are you going to be providing ongoing support? So maybe in the context of an annuity, you're going to go out there and visit the client once a year, maybe a couple of times. You're going to take a lot of phone calls. You'll be advising them on the complexity of the product and when to do RMDs and when to make changes and so forth. So the more services and the more complexity of the product that the department talks about, that can be a basis for justifying your commission. But you're also supposed to take a look at what's the market rate, kind of what's in the marketplace for whatever you're recommending. Is this reasonable? So expect that you're going to see, especially in the broker-dealer front, taking a look at levelizing compensation across similar asset classes. And so similarly situated, say, ETFs or even maybe annuities, similar products, similar durations, can and maybe should have the exact same compensation. And so we saw a little bit of that 5 years ago, and that, of course, rule got unwound, but I expect to see that again. And there's a requirement around documentation. We'll talk about that in a minute, and a retrospective review by one of the top officers of the company. So in the guidance here, I guess I'll supplement a little bit. What did we hear from the department a few weeks ago? One thing that they pointed out, and they went to lengths to talk about this, is that imagine you're looking at your advising client, maybe you need to do a 401k rollover because there's just not many good in-plan options. The fees are expensive. Maybe there's no annuities in there, and maybe annuities are a good fit for them. So the department said you need to be looking at that customer's old plan. Look at all the options, all the fees, all the costs of what is in the existing plan, as well as what's your recommended new lineup of financial products. And that indeed, it might make sense just to leave it in the plan, because there are certain protections provided there. And, fees are what they are. So being able to do and justify a real good faith and complete comparative analysis, whether that makes sense. And so they in fact said, well, you need to take a look at what are the long-term impact of costs. So maybe there's rider fees or ongoing charges that are associated with the recommended plan. How does that compare to what they have in existence right now? And they even have a duty to go take a look. If you can't get from the client information about the lineup of 401k options, you need to be looking at their Form 5500 and doing some benchmarking to see how does their lineup compare to what you're at. So that's a pretty laborious task to comply with this 2020 rule. That's what they're predicting that you need to be doing. And indeed, if you're, for example, the broker-dealer or an RIA firm, they're probably going to be scrambling to come up with a compliance plan in that regard.
Hey, Chris, we had a question come in. I mean, just asking, why would someone use a rule that's this complex?
Well, that's a good question. With regard to insurance and annuities, as we'll talk about here in the 8424 pathway, on balance is much easier. You'll see that it's a disclosure-based regime. There are different standards of care, but it's the 2020 rule. I think if you're selling products other than insurance and annuities, you're going to have to comply. You're going to have some compliance pathway, and that's really the only option. So talk about 8424. Good segue here. On the left there is, a slide shot from the rule that came out in the Federal Register in December. And indeed, the department said it is important to note that insurance and annuity products can also continue to be recommended and sold under the existing exemption for insurance transactions, that 8424. And on the right, there's from 1984, the actual rule. So that is a still viable solution. We'll talk about it here. We recommend that you certainly should take a look at that as a pathway at this time. It seems to work. So 8424, so the guts of it, it's really at its heart a disclosure regime, which means, you fill out a form and you got to hold yourself accountable to a higher standard of care, but there is no acknowledgement of being a fiduciary as there is with the 2020 version of the rule. There is no financial institution, an overseen entity that would have to sign off and have their own liability. So you don't have that complex oversight and the policies, procedures, and retroactive review and all those other things that go along with the 2020 rule. So in that regard, it's really a much easier pathway. We'll show you, we have a sample form we've created that can certainly recommend you take a look at. And a couple key pieces of this is that you have to, one, disclose the relationship that you have with the insurance company and any limitations. So maybe you're captive to that insurance company, maybe you're not, maybe you're independent, you're free to work with whoever you want. Second is you have a duty to disclose the amount of compensation that you earn first year or any trailing year. So maybe you have a trail commission. Actually jumping back up, the reasonable sales comp. So it does require a reasonableness, what's reasonable in light of kind of the market rate for what you do. And you may or may not think it's reasonable in light of what was kind of available in the marketplace, but you're supposed to be doing some benchmarking to see if what you're doing in light of the services and complexity of the product is consistent with the marketplace. And that would include all compensation, not just received from the carrier. So I don't know, maybe a IMO or somebody, you have a new producers program, and you have additional commission that might come in that needs to be disclosed as well. And then the last element is to comply with this is that you must describe all charges, fees, penalties, or adjustments under the annuity. So a lot of people in disclosure forms just cross-reference a lot of the many disclosures, the contract itself, brochures, etc., and that should meet many of the requirements of that prong. So we do have a compliance guide, and I know we launched a polling question about that earlier. This is available to you. It's a good way to understand exactly what this rule in totality means and how you can comply. Again, if you didn't answer the poll question you wanted, just reach out to us. We certainly can get it for you. The disclosure form. So we created a sample form that met those requirements. Again, the relationship to the carrier, commissions, and the contract charges. This is actually a form that's signed by the client and it's required to be kept, the record keeping, I believe 6 years, signed and dated, but you don't have to deliver it. You actually don't have to give a copy to the client. You just have to keep it in your own files for 6 years. There may be carrier-specific requirements coming. Certainly talking to a bunch of annuity carriers, I know they're scrambling to create these forms right now. I expect to see them kind of launch some sample ones that you can use. Generally, we don't expect they're going to want them back in their files. There's been some conversation about would we NIGO business, not in good order business, if they didn't return them. That may or may not be the case at carriers. I think they're trying to figure that out. But expect that you're going to see more carriers push out information with sample forms that you can make available. Here are the 3 carriers that we've seen so far. So we have American Equity back in March, Athene in March, and then the North American friends there, Kevin Meckley, who pushed out some information just recently. So the key point there is what we've been recommending is to take a real serious look at using PT 8424. So that's, again, the second compliance pathway. You could either use the Trump rule, which, as you probably heard, is pretty complicated, and ultimately components of that kind of spill into 8424, but 8424 being a disclosure-based regime of compliance is much easier. So you see American Equity say, American Equity does not intend to use the new exemption, meaning they're not going to be your financial institution. Instead, 8424, which requires a simple compensation and product disclosure, is applicable to insurance annuities, may be utilized. So they clarified that that would be a pathway. Athene, kind of a similar approach. 8424 seems to be the most likely exemption to be used by producers taking the safety net approach. And the Athene will not be using the exemption. So they're not going to serve as the financial institution. And the North American, similar kind of approach here, which is 2020-02 will certainly fit a number of distribution models, maybe like a broker-dealer that oversees all of your business. We do not intend to utilize this exemption at this time. So I think the carriers are, hedge a little bit, saying, well, gosh, if we had to, would we take a look at it? I know back 5 years ago, it was a similar kind of approach, and many of those carriers just didn't see that as a very easy way to serve as financial institution, because most of the producers are independent. They work for multiple carriers. So how you could oversee recommendations of an independent agent who might have contracts with 10 carriers would seem to be pretty impractical. And I think that's the concern that they've voiced here. So that guidance, a couple highlights there is, one, they clarified, yeah, this rule is effect. You need to be doing something right now. You can't just stick your head in the sand. That's not going to work. You need to be showing good faith compliance towards using that 2020 rule, or be using the 8424 compliance pathway. They confirm that rollover recommendations is fiduciary advice. So saying, hey, that 401k has limitations, you got to take a look at a rollover into an IRA. I can help you with that. That is indeed fiduciary advice. That's covered by this. You're covered as a ERISA fiduciary. They talked about differentiated comp, and that in and of itself can and oftentimes is a conflict of interest. So getting paid more for a similarly situated asset recommendation, yeah, and incentives that come along with that are certainly in the middle of I think the department's concerns there. And they even went to lengths, take a broker-dealer world, not uncommon, or even in the annuity world, to get paid, a retroactive bonus, when you get a higher payout or a higher grid level. And the department took a tack on that approach, and saying that certainly retroactively that creates a conflict of interest that seemingly can't be managed at all. Documentation is going to be critical. I know all of us feel like we continue to do more and more of this, and why do we need more? Doing a full-blown comparative analysis, again, like I did the example of looking at the Form 5500s, all the fees, et cetera, and taking a look at why you're better off with an IRA, that's going to be absolutely required, and you need to have a good repository to keep all that information. Taking a look at long-term costs. So it can't just be well, you're paying this fee right now. You need to be looking at the lifetime of the lineup they have now versus what you're recommending. They did say, insurance companies can, and maybe they should use this new pathway, this 2020 rule. I think a lot of carriers are struggling to see how they could in practice do that. We haven't seen any carriers say they'd be willing to serve as a financial institution. And if that's the case, unless you're with a broker-dealer or RIA that's going to oversee your sales, all of your sales, and index annuities, MYGAs, money going into life insurance or from qualified sources, that's going to be really hard, I think, for carriers to figure out a way to do so. They did affirm the 8424 is available, and it last said, we're continuing to look at issues of fact, law, and policy related to the exemption. More generally, its regulation of fiduciary investment advice. We think that's a bit of a euphemism to say we're going to take a serious look at maybe rewriting this. So we have the rule as is. One thing is to keep in mind with any state or federal rules is they're always up for potential change. Doesn't mean that passes court muster, but just know that new administration, not uncommon to take a look at this. I think some of it is to take a look at, has there been any problems out there? We really haven't seen much, but that's one area that I think the department is probably going to take a look at. So what about predictions? What are people thinking? What am I thinking that's going to be coming with this? Yeah, I would say this. On the left there is, the Capitol. We don't see anybody storming it today, thankfully. but it's possible that legislation could get through that would have some import on, the standard of care here with regard to qualified money, maybe money in general, with, the lineup of the Democrats controlling both houses and the executive branch. It's certainly a possibility that you'd see some additional legislation that might get sneaked into a bill that would provide a greater authority for the regulators to come up with new rules. So that's always a possibility. Don't see something imminent, but again, that could change very quickly. In the middle there, that's actually the labor secretary that's been appointed. That's Marty Walsh. He's kind of an old-fashioned Democrat from Boston. He's a labor guy. He's a pretty balanced, progressive, reputation. But he's got a lot of priorities on his plate here with OSHA and $15 minimum hour, and anything to do with COVID obviously is a priority. So whether he makes this a priority and maybe gets the right key people appointed inside there to make this a priority, we're not real sure. We would not be surprised to see the kind of career staffers inside there take a look at what they did back in the Obama administration, probably take another look at that court decision that bounced the rule and try to put up some defenses and maybe change the entire 5-part test, make it even clearer that all money in qualified money is in fact covered, but and potentially some changes out there. And then the last is the Supreme Court. So that other court decision, the Obama rule, was actually killed at the federal appellate level, not at the Supreme Court, but federal appellate level. It's binding law, that bounced out certain components of it. But is it possible that this rule or a changed rule could end up back in the courts? Yeah, it is possible. I'm not sure there's as much appetite by industry to challenge it again, but a lot of it depends upon what changes might come. So what do we have out there to help you? Last couple slides here. One, we have that disclosure form. Again, that 8424 process applies to insurance and annuity transactions. That's available to you. The Department of Labor clarified that. We have a sample form, happy to get that to you, and make sure you have a compliance pathway at this time because the rule is in effect. Second, we get that NEIC state best interest information. So we have that updated chart so you know whether you're in a state that has something coming or proposed. It kind of encapsulates a lot of what we're seeing from the carriers. We've been talking about this issue, I don't know, for a long time, Scott, even back to the Obama era. We've had lots of information. We put it in our newsletter. We've had webinars, thousands of people on it, thousands of phone calls, thousands of people angry or confused. Our goal here is to help, provide real-time information, real answers, and really help you comply so you're not going to run into any trouble. We have a great team here, and this is actually an important part of this rule is that you need to be able to defend your recommendations. So really, you need to be doing a full look at what you have access to, and you to be able to do that. It's not just picking up saying, hey, I just do business with 1 or 2 carriers. You probably need to be looking around a little bit further and see what else might better suit needs of clients. Be able to defend that and make sure you have that in your files. So that's something we can help here and do so day in and day out with Scott's team, obviously on the annuity side. And then carrier regulation. So, what carrier requirements are coming? We expect more coming. We know a couple carriers are going to have their own forms. We're a close partner with all the major annuity carriers, life carriers out there, and we will be on top of that, making sure you're not running foul any trouble. A couple questions we've seen, Scott. I'll try to address these fairly quickly as we're get to the top of the hour. So one question I know Curtis, our head of the marketing team for life insurance, he's getting a lot of questions like, are withdrawals from a qualified source to fund life insurance covered by this? The answer is yes, indeed they are. So really the scope of this rule is if you're advising a client at all with regard to their qualified money, you're covered. So if you went, hey, let's take out some qualified, qualified money withdrawals, fund life insurance, not uncommon a practice, that indeed would be covered by this, which means you'd have to have a compliance pathway. You can use, and our form is designed to cover that scenario with 8424. Second, I'm a rep or advisor. I got a supervising financial institution that's already complying with the Reg BI. Is this safe harbor? Meaning you don't have to do anything further. Well, the department said, no, it's not. You got to jump through an additional hurdle and that's not a quote safe harbor. Safe harbor legally means if you do, Reg BI, you don't have to do anything more. Department said no, that's not the case in their release back in December. So just keep in mind that's kind of part way there, but not all the way. And you're going to have a supervising firm that may or may not oversee your insurance and annuity transactions. So we know, I don't know, a fair amount of those broker dealers out there, the larger ones might oversee your say indexed annuities. Some do not, but they don't oversee your MIGAs. They don't oversee SPIAs. They don't oversee life insurance. And if you don't have a firm that's overseeing that, then the 2020 rule certainly does not work for you. So keep that in mind. Third is, I'm an agent. They adopted this. Maybe I'm in Arizona. They adopted that new 275 model, which is a best interest regulation. Is that good enough? Is that a safe harbor? The answer is no. So the department's clarified that as well in their releases, that you have to jump through this Department of Labor rule as well, or have an 8424 compliance pathway. So what about sub-agents? So I got sub-agents, split agents on cases, downlines. Who's got to do this form? Who's got to find a compliance pathway? So the key is if you have an agent, or you're the agent who is advising a client, you're talking to a client about and giving them a specific recommendation about what to do with their qualified money, you need to have a 8424 form, or somehow use the 2020 rule. So split agents, if they're both working with a client, they both need to have a form. I think they probably could do the same form as long as all the compensation was disclosed, or any other considerations. Number 5 is when will the carrier start sending out information? So they've just started. We showed you the 3 carriers, lead carriers that have sent information. We know several others are working right now on additional guidance. I know I talked to one of our leading companies, Scott, just last week. They expect something May 1st. Expect to see some of those 8424 forms as a recommendation, and we'll see more educational information coming out from them. 6 is what regulatory body could enforce this? So technically speaking, this is a good question. If it's a 401k, if it's advice regarding a 401k into an IRA, that would be the Department of Labor. They have authority under ERISA to bring an enforcement action on that. If it's IRA to IRA, that would be IRS. So ironically, the Department of Labor has like interpretive authority, but those would be the 2 different entities. It kind of depends upon if it's IRA to IRA or 401k, or a plan into a IRA. So those would be the parties. There is actually, this is a kind of a clarified note by the Department of Labor. If it's a 401k to IRA recommendation, there is a private cause of action. There is created what's called a statutory cause of action. So somebody could sue, owner of that IRA or the beneficiary could sue for a violation of this, claiming that the advisor didn't meet the fiduciary standards here, or didn't have an exemption. They didn't jump through the right things. So there actually is a little bit of a private cause of action, and potentially a fiduciary cause of action under state law. And then 7 is, could all this change? And as I was talking about before, I think it can. I don't know if I'd go as far to say is that it will be changed, but we do know it could change. That excerpt I pointed out seemed to suggest that I think the department wants to take a look at this and maybe blow up that 5-part test and make it, I don't know, a 1-part test, whatever, something that makes the scope of this very clear that everyone's covered. Would 8424 be on the table? I think it can and would be. I know a couple of law firms in DC have been suggesting that that's potentially on the table. We think it's a workable exemption. Frankly, we haven't seen, any abuses out there. However, the Department of Labor has a broad authority to do what they want. So it certainly could be. I guess I'd probably predict it. It would not surprise me if there was another crack at trying to do that. Now, that practice, that would probably take a little while. There's what's called a notice and comment period. The industry can comment about the proposed rule and so forth. But just as we saw the Obama administration, the department, once they get their teeth into something, they usually don't let go.
Fair enough, Chris. I appreciate the information as always. That was a heck of a presentation. A lot of research done on your part to be able to bring this. So thank you very much for that. One thing that I want to say to the group before we get into our very last slide is you see those 3 icons on there: Facebook, LinkedIn, YouTube. Throw us a follow. throw us a like. Definitely subscribe to the YouTube channel. A lot of times the fastest way for us to get you this type of incredibly relevant information is via social media platforms. So definitely a worthwhile follow. Of course, we got fun stuff out there as well. We got business stuff out there. But these are 3 great ways to connect with us and make sure that you're accessing all the information you need as quickly as possible.
Well, Scott, sorry, one other thing.
Go ahead.
I realized I didn't launch a polling question here. So something people, if you want in particular that 8424 form, we talked about that, the 1-page form, if you would like a copy of that, answer yes. And we will get that to you. We will have our Scott's team give you a call, talk about it, because again, this is a generic form. If you want to go visit with a lawyer, I'd recommend you do so. Each of your circumstances might be slightly different depending upon how you get paid, the nature of, what carrier relationships you have. But this is a really, really good template, and I would highly recommend you take a look at it. If you'd like a copy of that, again, say yes. We will give you a call, so please answer our phone call, because I want to walk through that with you. It's a pretty simple form, but just so you understand what that is.
Okay. Absolutely. Definitely request that form. We'll get it out to you as quickly as possible. And Chris, any other questions that came in, anything that popped up that you need to comment on?
No, I just appreciate, everybody joined us today. I know, heck, we've had a couple thousand now that have been on these webinars. We'll continue to do more of these as we get more developments. I expect carriers are going to have more information. The Department of Labor might have more guidance potentially, maybe a change. And so we're just on top of it. Our job here is to help you comply, make sure you kind of know what the state of affairs are out in DC or your individual state. So we got your back.
Absolutely. Hey, Chris, again, thank you. And thank you to everybody that joined us today. We appreciate your time. Go out and have a great sales day, everyone.